You are listening to The Vocal Technologist. Spoken Tech for your ears.
Robinhood Chain generated roughly $816,000 in gross revenue, but Ethereum captured just $1,500 of that. Let that land.
Yeah, that is a pretty staggering gap.
It really is. Welcome to Vocal Technologist. We're going to net out some fascinating notes on how traditional finance, AI, and crypto are colliding and completely skip the usual hype.
Right, because we want to take a proper look at the actual plumbing of modern finance.
Exactly. The stuff we're untangling covers everything from literal zero human companies to Wall Street quietly taking over blockchain infrastructure.
And the overarching theme connecting all of this is a massive structural pivot. I mean, the entire industry is aggressively moving away from those speculative token sale projects that grab all the headlines.
Yeah, the flashy stuff.
Right, and shifting entirely toward real cash flow businesses. It's a complete rewiring of who the technology actually serves.
Which is exactly why that opening stat caught me so off guard. I mean, if you're building a business, how on earth does Robinhood generate over 800 grand in revenue and Ethereum gets essentially a rounding error?
Like a fraction of a percent.
Yeah, it's wild.
Well, it comes down to a structural shift we call the Layer 2 or L2 barbell model.
Right.
So real businesses with massive user bases, think Robinhood or Coinbase, with their base network, they're choosing the Ethereum Layer 1 plus Layer 2 stack. But they use it in a very specific, calculated way.
Okay, so how does that actually work in practice?
Well, Ethereum itself, the Layer 1, is being used purely for data availability and final settlement.
Right, so it's incredibly secure and completely decentralized.
Exactly, but because of that, it's slow and expensive to use directly. So these companies build a Layer 2 network on top of it.
And the L2 handles the execution. All the actual trading, swiping, and interacting your users do.
Spot on.
I was trying to wrap my head around this, and here's the analogy that helped it click for me. Tell me if I'm off base here.
Go for it.
Think of Layer 1 Ethereum as the concrete foundation of a city. It's rock solid, it's highly secure, but it is astronomically expensive to build your house directly on it.
Yeah, you just wouldn't do it.
Right, so instead, Layer 2 is like a bespoke, multi-story shopping mall built on top of that concrete.
That is a great way to put it. Robinhood builds the mall, they set the rules inside that mall, they manage the security guards, they dictate the user experience.
And crucially, they collect the rent from every single shop and transaction that happens inside.
Right, and they just pay a tiny flat fee to the city for the use of the concrete foundation. By mathematically batching thousands of user transactions inside their L2 mall, and then submitting a single tiny cryptographic receipt down to the Ethereum Foundation, they capture almost all the value generated by their users.
Oh, wow. So they aren't doing this because they have some ideological allegiance to Ethereum.
No, not at all. It's just the most credible, neutral settlement hub available. They rent the security, but they keep the profits.
Okay, I get the infrastructure logic, but I've got to admit I have some genuine skepticism when you look at what people are actually doing inside that shopping mall.
You mean the actual trading volume?
Yeah, because Robinhood pitches this chain as the future for real-world assets. You know, tokenized stocks, treasury bills. They're even integrating heavyweight lending protocols like Uniswap and Morpho.
Right.
But when you look at the raw numbers, their decentralized exchange volume is almost entirely driven by meme coins.
Yeah.
Are they having a lend? I mean, how do you build a $5.5 trillion market for real-world assets on the back of speculative joke tokens?
It's a fair question, and the contradiction is very real. But you have to separate retail user behavior from global institutional strategy.
So retail is just distracted.
Absolutely. Right now, retail traders are treating it like a casino. They're looking at dog coins. But while they do that, global regulatory frameworks are moving rapidly to institutionalize the underlying technology.
Right, because Japan passed a bill recognizing crypto as a legitimate financial product.
Exactly. Treating it effectively like stocks and bonds and dropping the tax rate on it to around 20%.
And South Korea is expanding its state asset management laws to explicitly include virtual assets. So it's a split screen. Retail is playing around in the casino, but governments are quietly pouring the concrete for the legal rails. But why now? Why are all these massive jurisdictions moving at the same time?
Because they've finally realized the sheer efficiency of the tech. I mean, the UK just outlined a tokenized finance roadmap that projects tens of billions in economic output.
The trend is undeniable. Traditional finance is aggressively co-opting the technology.
They desperately want atomic settlement. which just means a transaction settles instantly and permanently without waiting 3 days for clearinghouses.
Yeah, they want programmable money and shared ledgers.
But, and this is the key, they are completely discarding the open, permissionless ethos of decentralized crypto.
Oh, absolutely. They want the lightning-fast efficiency of a blockchain, but they definitely don't want anyone looking at their books.
No, of course not.
The whole point of public blockchains is that anyone can see every transaction. A major bank can't operate like that.
Right. If you're JP Morgan moving billions of dollars for a client, you can't have your competitors tracking your wallet in real time.
Which creates a massive infrastructure gap. Banks running real financial flows simply cannot operate on a public ledger.
And that's why independent companies like ETH Systems are spinning up specifically to build modular, confidential infrastructure for institutional Ethereum.
Right, they're building private bonds and confidential stablecoin transfers. Because transaction-level privacy isn't just a nice-to-have. For traditional finance, it's a hard legal prerequisite.
It really is.
It makes sense. But it sets up this fascinating tension. We're watching human retail traders messing around with transparent joke tokens and human bankers demanding absolute privacy for their massive trades.
Yeah.
But there's a completely new dominant force emerging on the internet, and they don't care about either of those things.
Literal machines.
Yes, the agentic economy. This is what happens when artificial intelligence agents start conducting commerce on their own. The concept of a zero-human company is absolutely wild to me.
It's happening, though. There's an experiment running a full agentic banking operation on the Base network right now.
With zero humans involved in the loop.
Zero. Another one we looked at is making nearly $680 a week with 281 AI agent customers.
And all it does is scan machine-to-machine marketplaces for supply gaps and fills them. So if one AI needs cheap computing power to render an image and another AI has spare server capacity, this bot plays matchmaker. It facilitates the trade and takes a cut.
The fascinating part isn't just that they're trading, it's how they actually transact. I mean, think about it from a structural level.
Right, an AI agent can't just rock up to a local bank branch with a driver's license and a passport to open a business account.
Exactly. They are entirely locked out of the traditional banking system. So they use a protocol called BUY-402, and this is backed by major heavyweights. Visa, MasterCard, Ripple, Coinbase.
I have to say, the tech history behind BUY-402 is brilliant. Everyone listening knows the HTTP 404 error code. You click a broken link and get 404 not found.
Right, we've all seen that.
But Guide 402 activates the dormant HTTP 402 code, which stands for Payment Required.
Tim Berners-Lee and the internet pioneers built that code into the web's architecture decades ago.
Yeah, but it just sat there gathering dust because there's no native internet money to actually fulfill it.
Exactly. We had the command, but not the currency. And now, GEIS 402 uses crypto rails to allow AI agents to execute direct stablecoin transfers between clients and servers.
So no bank accounts, no monthly subscriptions, no human verification. It just settles in seconds.
And the concrete consequence of this is staggering.
It really is. These agents are executing micropayments in stablecoins for fractions of a cent per transaction.
Because if they tried to use traditional credit card rails, it would break immediately.
Oh yeah, the standard fee structure for a credit card is usually around 30 cents plus a 2.9% cut. That instantly bankrupts a machine-to-machine microeconomy.
A bot paying another bot 3 cents for an API call physically cannot afford a 30-cent surcharge. It only works on low-cost blockchain rails.
And that infrastructure bottleneck is why we're seeing such a lopsided ratio in these early zero-human marketplaces. There are far more autonomous agent buyers ready to spend money than there are sellers set up to serve them.
The demand for machine-to-machine commerce is already vastly outpacing the supply, purely because most platforms don't have the payment rails to accept a fraction of a cent from a robot.
Right. If you're keen on untangling these massive shifts with us, make sure you subscribe to the show. Because the irony here is incredibly rich. We've got AI agents zipping stablecoins around instantly for fractions of a cent. But when human beings try to use stablecoins for cross-border payments, it's rarely actually instant.
Yeah, this is where the grand narrative of crypto hits the brick wall of operational reality.
OpenFX provided a brilliant breakdown of this bottleneck. Imagine a $50 million transfer moving from Mexico to Dubai using stablecoins.
In a perfect scenario where the provider has direct regulatory access and pre-funded local liquidity in both countries, it takes about 18 minutes.
Which is great, but the exact same transfer on the exact same network can sometimes take up to 36 hours. 36 hours. The actual blockchain leg of that transaction takes, what, 5 seconds?
Barely. The 5 seconds is just the cryptographic settlement on the ledger. The remaining 35 hours and 59 minutes is entirely human bureaucracy.
So where does it actually get stuck?
Well, it gets stalled by manual batch processing on the fiat side. It gets flagged for a standard compliance review.
Which requires a literal human sign-off from a compliance officer sitting in a London office who has already gone home for the day.
Exactly. Or the transaction misses the local settlement window for the UAE's domestic banking system, so it just sits in a queue until the banks open the next morning.
The bottleneck is not the blockchain at all. It's the legacy operational infrastructure that we've duct taped around it.
Yeah.
That's a bit ordinary, isn't it? We build this lightning-fast 247 global network, and then we just strap it to a banking schedule that closes for lunch and takes the weekend off.
It's wild. But because the sums of money moving through these networks are so massive, it's kicked off a brutal turf war over the stablecoins themselves.
Absolutely. Wall Street is getting incredibly cautious on Circle, the company that issues the USDC stablecoin.
Massive institutions like JP Morgan and Mizuho have actually downgraded their outlooks on them.
And the primary reason is a new rival, the OpenUSD Consortium. It has over 140 members, and we're talking massive legacy players like BlackRock, Visa, and MasterCard.
Right. It's a classic distributor war.
Think of it like a major supermarket chain. They go to a mid-sized cereal brand and say, look, we'll give you premium shelf space in thousands of stores, but we demand 100% of the profit margin on every single box sold.
Yeah, and if you don't agree, you lose the shelf space.
Spot on. The OpenUSD Consortium is essentially demanding that nearly all the yield generated from the stablecoin's dollar reserves gets routed back to them, the distributors.
Which forces independent issuers like Circle and Coinbase into this brutal prisoner's dilemma. They have to compete on increasingly aggressive revenue-sharing terms just to keep their stablecoins circulating on the big platforms.
And the global race to capture all this stablecoin liquidity is heating up in places you wouldn't expect. Look at Japan.
Oh, yeah. SBI is launching a yen-pegged stablecoin lending service.
Offering a 3% annualized yield. Now, 3% might not sound crazy to us, but when traditional Japanese bank deposits offer literally a fraction of a percent, a guaranteed 3% yield is a massive magnet for capital.
Capital will always flow to where it's treated best, but wherever there's massive liquidity sloshing around, you inevitably find operators looking for an edge.
Or a vulnerability to exploit. Which brings us to the dark arts of the market. Poly market.
Right, the prediction markets. They've seen explosive growth, but they're facing some serious structural and regulatory headwinds.
I was reading a Stanford study that looked into Polymarket's 5-minute Bitcoin prediction markets. They found that over 800 suspected manipulators pocketed $8.2 million. I mean, how does this even happen? I thought the whole point of a decentralized platform is that it cannot be rigged.
Well, it's not the blockchain that's rigged. It's a structural flaw in how the market actually resolves the outcome.
Okay, walk me through it.
These specific 5-minute contracts rely on a single exchange oracle to determine the price of Bitcoin.
Right. So for anyone listening, the oracle is basically the referee. A smart contract on a blockchain cannot magically see the real-world price of Bitcoin. So an oracle feeds that data into the contract to decide who won the bet.
Exactly. And in this case, the referee was pulling price data exclusively from Binance.
So well-capitalized traders figured out an exploit.
They would open massive positions on the prediction market, betting that Bitcoin's price would go up or down.
Then, in the final seconds before that 5-minute contract settled, they placed huge spot orders directly on Binance. So they artificially spiked or crashed the actual price of Bitcoin on Binance, just enough to engineer the outcome of their bet.
They manipulated the referee to win the game.
They spent a relatively small amount of money moving the needle on Binance to win a substantially larger payout on Polymarket. That is incredibly dodgy.
It really is. It highlights the massive risk of single exchange oracle concentration.
Because if a trader's capital can move both the betting contract and the underlying reference price, the platform stops being an information discovery mechanism and turns into an outcome engineering venue.
And regulators are absolutely watching this. The Czech Republic just moved to block Polymarket entirely over unlicensed gambling concerns, joining a very long list of other countries restricting access.
So you've got oracle manipulation on one side, but to be fair to the other side of this argument, the networks themselves are actually getting much better at blocking bad actors at the base layer.
The structural improvements on security are actually significant.
Yeah, for example, Circle's new architecture did something quietly revolutionary. They deleted the public mempool entirely.
The mempool being the waiting room where your pending transaction sits before it gets officially written into a block?
Yes. Normally, front-running bots constantly monitor that public waiting room. If they see you're about to make a profitable trade, they instantly copy your trade.
They pay the network a slightly higher fee to jump the queue and execute their trade before yours. It's an invisible tax on everyday users.
By completely eliminating that public mempool, Arc stops those front-running bots dead in their tracks. It hands the transactions directly to the validators in secret.
I love that. And then there's Tempo, who introduced receive policies, which sounds incredibly dry, but it fixes one of the most annoying things about using crypto.
Oh, absolutely.
Historically, any random anonymous address could send a dodgy scam token to your wallet, and you couldn't do a single thing to stop it. It was just stuck in your wallet.
Right.
Now, you can actually set a protocol-level rule blocking specific tokens or specific senders. You finally have consent over your own inbox.
And these base layer upgrades explain why the broader security narrative is shifting so dramatically. There was a widespread prediction that AI-powered attackers would trigger a decentralized finance hackpocalypse.
Right. Everyone thought we'd see a wave of super smart bots just draining every single protocol on the internet overnight.
But it didn't happen. The total number of security incidents actually hit a record high, but the overall financial losses dropped significantly.
Wait, really?
Yeah, what occurred was a security bifurcation. The large blue-chip protocols used AI themselves to rapidly harden their defenses, completely locking out the attackers.
So the only platforms taking real damage were the small, under-resourced projects and abandonware. The big players adapted much faster than the threats evolved.
The quiet part nobody is saying out loud is how aggressively the biggest players are playing defense.
Look at MicroStrategy. They hold over 800,000 Bitcoin on their balance sheet. But when they needed to build a massive cash reserve, they didn't touch a single coin.
They sold $467 million in company shares instead.
It just proves that when the pressure is on for these massive corporate treasuries, the company's equity is the sacrificial lamb. They'll happily dilute their shareholders to protect the core crypto asset.
It's a very deliberate tactical shift. They are using traditional capital markets to shield their primary treasury asset.
Absorbing the pain on the equity side rather than realizing taxable gains or spooking the market by selling their Bitcoin position.
But to balance out these massive institutional whales, we have to mention the solo miner.
Oh yeah, some bloke running a $150 BitTax mining rig in his house hit a literal 1 in 18,000 year jackpot.
He mined a block completely solo and walked away with $200,000.
You have to love a genuine underdog story in a space that is increasingly dominated by Wall Street giants.
It's a profound statistical anomaly, but it serves as a great reminder of the network's decentralized roots, even as the infrastructure heavily professionalizes around it.
It really is an industry operating in two entirely different realities right now. You've got everyday retail users absolutely distracted by the casino, gambling on joke tokens and meme coins.
But beneath all that distraction, institutions and AI agents are quietly and systematically rebuilding the internet's financial plumbing.
If autonomous agents truly become the dominant source of internet traffic, the next generation blockchains won't be built for human eyes at all. They'll be entirely invisible, optimized exclusively for machines negotiating with other machines in the dark. Keep an eye on who is building those machine rails. Vocal Technologists, see you soon.
Spoken Tech for your ears.